Imagine you are living in 1927. The stock market has been climbing for years. Technology is reshaping daily life faster than most people can process. Consumer credit has made luxury accessible to ordinary households for the first time in history. And the general mood across the country is one of quiet confidence that the system has finally figured itself out. Newspapers are writing about a new era of permanent prosperity, and almost everyone you know has some money in the market, either directly or through the financial instruments of the day. It feels different this time, and most people genuinely believe that, because in many surface-level ways, it is different. But underneath the surface, the mathematical structure of what is happening is not different at all. What is unfolding in the mid to late 1920s follows a pattern that economic historians have traced across dozens of financial cycles, going back centuries. And the reason it keeps repeating is not because people are foolish, but because the psychological conditions that produce these cycles are deeply embedded in how human beings relate to wealth, risk, and social proof. When everyone around you appears to be winning, the rational feeling choice is to participate, and that participation is precisely what inflates the structure further until the mathematics of it become physically unsustainable. The 1920s bubble had four defining characteristics. First, there was a genuine technological revolution happening. The automobile, radio, and electrification were real transformations with real economic value, which made it genuinely difficult to separate the legitimate growth story from the speculative excess layered on top of it. Second, consumer credit expanded dramatically, meaning that for the first time, ordinary middle-class households could borrow to invest, borrow to consume, and borrow to participate in an asset price environment that appeared to be always moving upward. Third, wealth concentration accelerated sharply, with the top 1% of earners capturing a disproportionate share of the decade's gains, while wage growth for workers remained comparatively flat. And fourth, a financial industry had developed sophisticated new products, investment trusts, and leveraged vehicles that allowed ordinary people to gain exposure to assets they didn't fully understand through instruments whose internal risks were not transparent. Now consider the present. There is a genuine technological revolution happening in artificial intelligence, digital infrastructure, and biotech, and it is producing real economic value that makes it genuinely difficult to separate legitimate growth from speculative excess. Consumer credit is at historically elevated levels, and an entirely new class of retail investors entered markets in large numbers beginning around 2020, many of them using borrowed money or margin accounts. Wealth concentration in the United States today has returned to levels that, by most measures, closely mirror or exceed those of the late 1920s, with wage growth for median workers lagging significantly behind asset price appreciation. And financial markets have developed a new generation of complex instruments, leveraged ETFs, zero-day options, synthetic derivatives, that offer ordinary investors exposure to amplified risk through products whose mechanics are opaque to most of the people holding them.
The parallel is not exact, and it would be intellectually dishonest to suggest that history simply repeats in identical form. The Federal Reserve exists today in a way it did not in 1929. Regulatory structures are more developed, deposit insurance prevents bank-run cascades of the classic variety, and global economic interconnection creates both new stabilizers and new transmission mechanisms for instability. But the parallel is close enough that it demands serious analytical attention rather than dismissal. The pattern is not in the specific assets or the specific technologies. It is in the behavioral and structural mechanics: credit-fueled asset inflation, widening wealth gaps, retail participation in instruments that concentrate rather than distribute risk, and a widespread psychological conviction that current conditions represent a fundamentally new normal. What actually happened after 1927 was not an immediate crash, which is itself an important part of the story. The market continued rising for 2 more years, which meant that anyone who recognized the structural risks in 1927 appeared to be wrong for an extended period, and the social cost of appearing wrong in a rising market is high enough that most people capitulated and re-entered before the correction came. The crash of 1929 did not just erase recent gains, it unwound the leverage that had been embedded in the system over the entire preceding decade. And because that leverage was so broadly distributed through the credit system, the economic contraction that followed affected people who had never owned a single stock. The mechanism of transmission was debt, not equity, and the same mechanism exists today in more complex and globally distributed form. Understanding this parallel is not about predicting a specific outcome or a specific date. It is about developing what economists call structural literacy, the capacity to recognize when the shape of a system resembles shapes that have historically preceded significant reorganization. Wealth is not lost in these cycles so much as it is transferred, from people who were holding leveraged positions when the mathematics corrected, to people who are holding liquidity. The psychological challenge is that holding liquidity in a rising market feels like losing, which is precisely the behavioral pressure that keeps most people fully exposed until the moment when exposure becomes expensive. The 1920s did not end because someone predicted it would end. They ended because leverage has a ceiling that is set by mathematics rather than sentiment, and sentiment, however confident, cannot renegotiate with arithmetic. That is the lesson the cycle keeps trying to teach, and it is a lesson that is most useful before it becomes necessary.